You pull out your wallet, you have the cash, you could pay right now and walk away clean. No bill, no statement, no interest, just done. But the person next to you, the one with the nicer car, the bigger account, the portfolio you'll never see, puts it on the card without blinking, and you've always wondered why. The answer is stranger than you think. It isn't about points, it isn't about convenience, and it has almost nothing to do with the credit card itself. What's actually happening when wealthy people refuse to use their own money is a quiet, systematic exploitation of a principle that most people have never been taught. A principle that, once you understand it, will change the way you look at every dollar you spend, save, or invest for the rest of your life. Let's start with something that sounds like a paradox. Money you spend is gone. Money you don't spend is still yours. That's obvious. But here's the part that most people miss. Money you delay spending can work for you while you delay. And if you understand how to delay long enough, on the right things, in the right way, you don't just save money. You manufacture time. Economists call this the time value of money. $1 today is worth more than $1 tomorrow because $1 today can be invested, compounded, and grown into something larger than $1 by the time tomorrow arrives. This isn't a theory, it's a mathematical fact that underpins every major financial decision made by every wealthy person, institution, and government on the planet. Nassim Taleb, the statistician and author of The Black Swan, has written extensively about how the wealthy think about optionality, the value of keeping choices open. Cash, he argues, feels like freedom, but cash that leaves your account immediately closes options. Every dollar paid upfront is a dollar that is no longer available to seize an opportunity, weather a crisis, or compound quietly in the background. The rich aren't being reckless when they borrow, they're preserving optionality. So let's run the actual numbers, because this is where it stops being philosophical and starts being real. Say you have $40,000, you're buying a car. You can pay cash and the car is yours immediately, no debt, no monthly payments, clean. Or you can finance it at 4% interest, keep the $40,000 invested in an index fund, and let the market do what it has historically done, return somewhere between 7 and 10% annually. The math on that decision, played out over 5 years, means you come out ahead even after paying the interest. The investment grows faster than the loan costs you. The wealthy person knows this. The average person doesn't, but it goes deeper than that. Morgan Housel, the financial author behind The Psychology of Money, writes that wealth is what you don't see. The cars not bought, the jewelry not worn, the first-class seats not taken. He describes how the people who look the richest are often the ones hemorrhaging money to maintain an appearance, while the people who actually have substantial net worth are the ones quietly using leverage, delaying payments, and letting compounding do the heavy lifting. Wealth isn't a display. It's a habit of behavior repeated over decades. Here's a behavior the wealthy repeat constantly. They borrow against assets they already own. This is called asset-backed lending, and it's one of the most powerful and most hidden financial strategies in existence. Here's how it works. You own stock worth $5 million. You don't sell it because selling triggers capital gains taxes. Instead, you go to your bank and borrow against it at 2 or 3% interest. You use that borrowed money to live, to buy the house, the boat, the experiences. You never sell the stock. It keeps growing, and because borrowing is not income, you pay zero income tax on the money you just received. This is not illegal. This is not a loophole being shut down next quarter. This is the system, working exactly as designed, in the hands of people who understand it completely. In 2021, an investigative report by ProPublica analyzed leaked IRS data and found that some of the wealthiest individuals in the United States paid effective federal income tax rates in the low single digits, sometimes zero, not because they cheated, but because they used this exact strategy. Borrow, don't sell, spend the loan, let the assets compound, die wealthy, pass the assets to your heirs at a stepped-up basis that erases the embedded gains entirely. You will never hear this explained in a high school economics class. Now, back to the credit card. For someone operating at a smaller scale, the same logic applies. When a wealthy person uses a credit card, they are not borrowing because they lack money. They are borrowing because their money is more valuable elsewhere. Every dollar kept in a brokerage account, a money market fund, a high yield savings account, or an investment earns a return. Every day that dollar sits there earning a return is a day the credit card company is essentially lending you their money for free. As long as you pay the full balance before interest kicks in, this is called the float, the gap between when you spend money and when that money actually leaves your account. For 30 days, sometimes more, that money still belongs to you, still earns a return, while someone else has already delivered the goods or the service you used. At an individual level, the float on a credit card seems trivial. 50 cents, a dollar, who cares? But compound that behavior across an entire portfolio, across decades, across every purchase made with someone else's money for 30 interest-free days, and the math becomes significant. More importantly, the habit becomes identity. You stop thinking of spending as a subtraction event. You start thinking of spending as a cash flow management decision. Behavioral economist Richard Thaler, who won the Nobel Prize in Economics in 2017, spent years studying something he called mental accounting. The way humans unconsciously treat money differently depending on where it comes from, where it's going, and how it feels to spend it. His research showed that people who pay cash feel the pain of a purchase more acutely than people who pay by card. The physical act of handing over bills activates loss aversion in the brain. Swiping a card doesn't. The wealthy have essentially found a way to turn that psychological quirk into a structural advantage. They use credit for everything, feel the transaction less viscerally, pay it off fully, and keep their actual capital working harder than yours. This is not an accident, it is a philosophy. There is a concept in finance called OPM, other people's money. It is the foundation of almost every major fortune ever built. Real estate investors use mortgages so they can control $1 million asset with $200,000 of their own. Private equity firms use debt to acquire companies so they can amplify their returns beyond what their own capital could produce. Venture capitalists use fund structures to invest other people's savings into startups they believe in. The wealthy have internalized one truth above all others. Leverage is not a sign that you need money. It is a sign that you understand money. Meanwhile, most people have been taught the opposite. They've been told debt is shameful, that borrowing is a failure of discipline, that the goal is to be debt-free as quickly as possible. And for high-interest consumer debt, credit card balances carried month-to-month, payday loans, car loans on depreciating assets, that advice is correct, but the wholesale rejection of leverage, any leverage, leaves most people unable to play the same game the wealthy play every single day. Here's the uncomfortable truth. The system is designed to reward people who understand capital allocation and punish people who don't. The credit card company makes money from the merchants who pay processing fees on every transaction. The wealthy user collects rewards, cashback, airline miles, hotel points, and pays zero interest. The merchant builds those fees into the price of every product sold, so people who pay cash, often people with lower incomes, are effectively subsidizing the rewards programs enjoyed by wealthier cardholders who never carry a balance. The credit card industry has built a machine that transfers wealth upward invisibly on every single transaction. This isn't a conspiracy theory, it's math. And it's been documented in Federal Reserve research for decades. So what do you do with this? You start by understanding the principle. Cash feels safe, cash feels honest, cash feels like you're living within your means, but cash spent immediately is cash that can no longer earn a return. Delayed spending, managed intelligently, without interest, without debt you can't pay, is one of the most basic levers of wealth accumulation. The wealthy don't refuse to pay cash because they're showing off. They refuse because they've run the numbers. The next time you pull out your wallet, the money you have is already there. The question the wealthy are asking, and the question that changes everything, is not whether you can afford it. It's whether you should let it leave your account right now, or whether it could be working harder somewhere else for 30 more days. That decision, made the same way again and again over years and decades, is the real reason the gap between the wealthy and everyone else keeps widening. Not income, not luck, not inheritance, just a different answer to a question most people never learn to ask. You have the cash. The question is, should you use it?